Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Tuesday, March 1st, 2022. So as we head into the first trading day of a new month, I wanted to go over a few other things and just kind of share my thoughts here. I'm keeping a lot of my focus concentrated on mainly the major stock indexes and related peripheral trades, such as the VIX, for example. That's inversely correlated. To be right on a correction in the stock market is the same as being right on a bullish call on the VIX. There's never ever been a time where the market dropped substantially and the VIX didn't go up, and it goes up in a multiple of whatever the index will drop. So you can sort of look at it as a leveraged play on the equity markets. And so, and then the other related things are treasury bonds, gold. They're all, risk on, risk off. And some of those have a higher correlation than the other. For example, the VIX is more correlated to the stock market than is gold, or even treasury bonds, which are usually inversely correlated, but that correlation from time to time can be disconnected. But for the most part, when you look over 20, 30 years, you see a pretty good inverse correlation. All right. What I wanted to do in this video, we'll keep it quick. I wanted to address, there were a few questions in the comment section from yesterday's post, or no, this was this morning, and I just caught up to those, and I'm going to answer those for the benefit of everyone. So here's one question. Okay, good call last night. When to short again? Can you please let us know? Well, I want to share my thoughts on that. Okay, so obviously, as I mentioned in the video earlier today, when QQQ hit that downtrend line yesterday, which was in conjunction with that PPO sell signal, I gave you that level 0.53 or whatever it was, where you get to the on the PPO, and for months now, it's with every instance, it's hit crossed above that level. That's coincided with at least a short term or a tradable top. So that was one. Then, of course, we went on, and again, that's covered in these. The breakdown of those 60-minute bearish rising wedges is on wedges on all the major stock indexes. That was NQ, Nasdaq 100, ES, S&P 500, and the RTY small caps. So there were three objective shorting ops in the last since yesterday. You remember the first one is that pushback into the trend line with that in conjunction with that 60-minute PPO sell signal. You remember, if you're going to short, there's two objective times to short: either a rally back into resistance during a downtrend, or at a point where you expect another leg down, bounce back to resistance, just like in a long. When you're going long, you want to buy a pullback to support. And the other objective short entry is a breakdown of a bearish chart pattern, or a breakdown below support, such as those bearish rising wedges, when you broke the uptrend line that defined the bottom of the wedges, and then again on the back test. So you had two instances there: the break of support, the trend line, and then the kickback to back test those wedges. And now what I'm going to go over in this video is I'm going to cover this part of it. Just keep looping back to these market-leading FAANG stocks. So it won't be a super long video. I'm going to go over the FAANGs and maybe a handful others of the top stocks in the Nasdaq 100, as well as the S&P 500, and I want to cover this part of it. And stay where we're at. This could be the last chance. Not a hard line here. Maybe tomorrow we get additional, maybe over the next week, but roughly these levels may be the last chance to load up. If, again, it's a big if we're going down to those deeper targets. So I'm going to get to that in the video. Any comments on the DAX? That's the German index, the DAX. And my reply is I'm hyper focused on the U.S. markets now, but I'll take a look, and I will go over that. We'll look at the DAX here. If you are over in the UK, look at the FTSE. If you're in Australia, look at the ASX. Any of those indexes you want, just let me know. If you're a subscriber, drop it here, and you're the only subscribers can comment here. So I'll get to that. And here's one that I like this idea. I always talk about doing it, and then I end up just getting on covering everything that's kind of on my mind that day. What I usually do in videos is I cover the things that are relevant at that point in time or stand out, and whether those are actionable trades, maybe something just broke out or broke down, I want to get that out in the video as soon as possible. And the other things are setups, things that I think I like to get setups out to you guys in advance. and it's a fine line. I don't want to get setups too far in advance. It just kind of dilutes my analysis. If I'm throwing out 100 trade ideas, or let's say a couple dozen, you kind of lose focus. So I try to highlight those that stand out with the most potential, the best setups, and also get them out to before they break down, just before they break down, not too far ahead. Sometimes I will talk on setups for weeks, months, because they continue to develop. They continue. Let's say it's in a bullish chart pattern, a falling wedge or something. It's going to keep going down, down, down. I may continue to revisit it. Maybe we didn't have a buy signal at all, and it's continued to be in the downtrend, but divergences build. There's a clear trend line to watch, and maybe I thought it might have the chance to pop 2 months ago and it didn't, so I'm going to keep looping back on that one. So that's what I'm usually doing in the videos, but there was a suggestion here, and I like it, to put short videos around 5 to 7 minutes, but multiple videos during the day. And one of those maybe before the close, one after the close. So I usually try to do that if there's anything that I think is relevant before the end of the day to share my thoughts before the market closes. I'll usually try to get one out to you guys. If not, then it's an end of day video, and if there's nothing really new to report, I skip the end of day. So my reply was, I'll certainly work towards that. I can't promise a 5-minute video, but I do like the idea of breaking them down, and maybe I'll not always, but I'll make a point more so to going forward to cover one that's just on the stock market, or maybe a closely related trade such as the VIX. And then the next video, instead of covering gold, like I did today, for example, I covered the stock market in the last video, as well as treasury bonds and gold. And yeah, they're all kind of related because equities are a risk-on, risk-off asset. Right now it's a risk-off market. Speaking towards the intermediate term trend, not the last few days. I'm talking the last few months. We're in a downtrend. Whereas gold and treasury bonds are in risk-off mode, meaning they rally when it's a risk-off market. When it's a risk-on market, investors and traders are buying riskier assets, stocks, especially tech stocks, Bitcoin, speculative stuff like that. So I will make a point to do this, and I know that's going to be easier for you folks that might just only have a few minutes on your break if you're working, or just don't want to listen to a 30-40 minute video. All right, so I'll work towards doing that for you. And there it is again, short updates, much appreciated. All right, let's before I forget to do so, let me look at the DAX. This charting program I'm on right now, I have other chart programs I'd have to pull up that do have the DAX index, but here's an ETF that appears to track the DAX. So it's going to be close enough. The price levels are going to be different, but the chart should look the same. And here's the thing. Well, my reply. Let me go back to that post. What I said in there, is of course the rest of the developed countries tend to follow the U.S. So assuming my next downside targets are hit, I'm referring to the targets on the weekly charts of QQQ, IWM, etc. If those are hit, it's almost certainly the DAX is going to come along for the ride. It may not be dollar for dollar, but for the most part, if those targets are hit and the U.S. markets bounce, the DAX is going to bounce that night. If the U.S. futures turn around and ramp a big, rally off the next target levels, put very good odds that the DAX will follow. If not immediately, within a day or so, especially if it's a sustained rally. All right, let me get to that chart. Go back there. DAX looks like the ticker for this Recon Capital DAX Germany ETF. And this is a weekly chart right here, but it's very clear that the DAX topped and is in a downtrend. There's your peak. There's your downtrend. And this is a clear one. They're not always so clear. A downtrend, again, being a series of lower lows and lower highs. And it's starting to accelerate down. Obviously, Germany's a lot closer to the mess over there than the U.S. is. So although it's everyone's problem right now, those countries that have to deal, especially with Germany and the whole pipeline deal with Russia and all that. It's sticky. I don't have to tell you that. It's a mess. So you can see this is a downtrend. I don't have strong thoughts or haven't really studied this chart as to where it goes. All I can tell you, it's in a downtrend. Don't fight the trend. There's no evidence of reversal, that I can tell you. The best I can say is that you're oversold, but again, oversold is not a buy signal. It can become more oversold or stay oversold for an extended period of time. So I wish I had a stronger opinion. I can give you on this daily chart. I do see a level I meant to mark up before. That's I'm going to give you one more. This is support right around here. These are the levels that I see. So we're coming up around 27. Again, this is an ETF, and my apologies because I know that's not the same levels as the DAX index, but very close. So here's what I see. You had a rising wedge pattern right there, and you had negative divergence. Very clear top, and we've been moving down as I just showed you on the weekly chart since. That selling has started to accelerate. By the looks of the volume, it doesn't look like a selling climax. A selling climax will come at the end of a bearish trend, usually a much longer trend, and say that it's the seller exhaustion. And it could be what's in play here, but I don't think so. So we're coming up on the first decent support level here, about another from where we closed today, or where this ETF closed, or the low of the day. Was about another 1.34%. There's some support there. I don't want to spend out too much time, but I don't have a lot of, again, a strong opinion, but it's well below all the key moving averages and everything else. And it's not a good looking chart. And even on the weekly chart, oversold, but that's this one doesn't go back to the last bear market. And if I could do that, then I would show you that oversold can and often does become more oversold or stay oversold for an extended period of time in a bear market, if indeed that's what this is. Unfortunately, it's still too early to say with the highest degree of confidence this isn't just a regular correction, another correction on the road to new highs. I don't think it is, but if it is, then yeah, you're going to look back and say, well, oversold. There's a little divergence on the RSI, not so much on the PPO anymore. But let's move on. Here's what I wanted to show you on the markets. I want to show you QQQ. Let's go out to weekly chart. And again, it speaks to the opportunities for shorting. So there's QQQ. Below the red and blue line here are the 200-day simple and exponential moving averages. So it speaks again to where I think we're at. And although, here's the way it is. If you ask, the best shorting ops, obviously, we're up near the highs, and we're not there. And then along the way, well, we had another shorting up when we broke that support. We had another shorting up when we back tested. So there's numerous shorting ops. If you're trying to game this trend or micromanage or add, everybody's different. Some people didn't want to short here, thought it was crazy shorting an uptrend. You certainly had some that panned out back here only to the first target or second or third, but missed my fourth or fifth target. But I don't recall since then. I think the last time I had long-term targets on the weekly chart was before COVID hit, and we hit it on the S&P 500. Those were the would have changed that board by now. Let's see. I had these this level back here. Where did it go? Well, but way back then on those charts, it was the when we were up in here with these divergences, I was targeting those 2015 highs right there, and that's what we hit. I guess it's been so long since we hit it. You can see that's where the S&P fell down to just about when COVID hit. So it was a quick over before you know it kind of bear market, or really what I call correction. And what I want to show you now is where we're at and speak to, is it still objective? So there's the 200 simple, the 200 exponential. So we've had, since we took out both those moving averages, we've had a couple bounces back to the 200-day exponential. We even had bounces back initially all the way to the simple, and we're below those. So there's not, that's where I do these videos where I do move down to the 60-minute charts to really try to hone in on those entries and exits, and that was where I started out this video. You had that shot yesterday on the bounce back to the trend line and that sell signal. You had it again today on the breakdown of the those 60-minute wedges. When I look at this, I'm going to say the next, very clear objective short entry is going to be a break of that 415 first target on SPY or target level, or especially the recent lows. But that's going to be a ways down. So until then, we're going to just micromanage on the 60-minute charts, and I'll be telling you where I think it's time to start either stop adding or unloading it's kind of a moving living thing each and every day as the levels change and certain developments happen. So I may kind of back off my bearish stance one day based on something I'm seeing, and then all of a sudden you get rejected, and we're back on. So nothing's changed bigger picture. Let me get to the levels I wanted to show you. So the big thing are those 200-day moving averages. When they break, which again on this weekly chart, 200-day moving averages are the same as 40-week moving averages. Broken there, boom, the bottom fell out. You had a back test on the first week, but remember, COVID happened. COVID was a correction or bear market with the fast forward button hit on like 5 times speed because of the fact the virus kind of took everybody by storm. And again, the technicals were pricing in the correction even down to where we went based on the weekly chart, but it happened a lot faster because the shutdowns in the economy and everything else as the news built, and then it was again almost over before we know it. But normally, when you break the 200s, here you did it back here in the fourth quarter of 2018, you broke them, you back tested several times over a matter of about a month or so, multiple opportunities, but each and every time you failed. Even if there was a brief intra-week pop above it, you tended to close the week down back on those levels or below them, and then boom, the big drop came at the end there. And again, I've covered this many times in the past. I know as I zoom out, it's hard to see. I do strongly encourage everybody to look at this stuff yourself and find other moving averages, find faults with what I'm doing, question it. I want to be I want somebody to bring up something I'm missing, something I don't see, or something that maybe I think I see, but hey, Randy, it's not really if you look at it this way. Put those in the comment section below. But you can see there, stick save, stick save, stick save, stick save, boom, finally a breakdown, big red candle. Back tested, came a little above it for a couple weeks there, but hardly. It's effectively a back test. You can't take these literally to the penny. You're talking volatility's high, but again, you can see that. I think you can see that there. That's how it played out. Big red candle was your breakdown candle. Back tested for over a month there, everyone's a week, so you got at least a couple months there. Failed to recover the 200s on a meaningful sustained or meaningful move above them, and then boom, the other leg down. That was the bear market back, or deer market, sideways to down market, lasted almost a couple of years there, and you had another leg down. Then you finally recovered them, and then you recovered them, boom, bullish. So that's, again, I could go back in time and show you each and every time. I can go back to the last real bear market we had in 2007. We were dancing on the 40 weeks, dancing on them. So, and then finally broke it here, back tested. Up. We had a big leg down. This is when people were still buying dips, thinking it's a correction. That's that last relief rally. This is where the Elliott waivers really shine when it does work well. You get an initial leg down, wave 1. This is a primary 5-wave cycle. Wave 2 is a counter trend wave. Look in the bigger wave count. Wave 3 is always the biggest and most powerful wave down, because that's that kind of what I often refer to as rut row or POR, I call it point of recognition moment, where dip buyers and bulls realize something's wrong, something's not working. I've been buying the dip since we topped, and every time we go up, I keep getting lower and lower, and then boom, after they got rejected, and again, it was technically based as well. The dip buyers might not have been aware of that, they might not have been looking at that, but it was a rejection off those 40-week moving averages, and the market never looked back, and when it recovered them there, told you, hey, things were over. So that's where we're at again. So I'm just going to rifle through some of the big fangs, and we will wrap this video up just to show you where they're at. And Apple, again, one of the biggest holdouts, the biggest publicly traded company in the world, recently hit a rare, Rare was the first and only $3 trillion company, and now it's back down to $2.7 trillion. Still a big company, and hey, a great stock, great company. Hard to knock it, but it's all about the technicals, and it's all about the rest of the lot, meaning the other stocks in there. Apple can do what it wants to do. It can sell a gazillion iPhones, but when the market breaks, people start selling. There's more sell orders. People are liquidating mutual funds, pension plans. Ooh, I want to talk about that real quick. They're liquidating, they're selling to protect, minimize losses, and Apple live by the sword, die by the sword. Well, live by indexing, die by indexing. It's indexing that brought Apple up to where it was. It's a great company, but being the highest weighted index component in the S&P 500 and in the Nasdaq 100, it is the largest beneficiaries of inflows. You don't know it. You may not have ever bought Apple stock in your life, but everybody listening to my voice probably owns it. If you have a 401k or any type of mutual funds, you own Apple. It's probably the largest holding in your 401k, in your equity portion, because of that simple fact, highest weighted. Whether you own an indexed fund or a actively managed fund, trust me, those active fund managers, they tend to mirror the S&P 500 anyways, to a large extent. So that's it, and so that's why Apple will go down ultimately to these longer term targets when we finally do get the next true bear market, whether it's coming, whether we're already in it now in the early stages, or whether it's a year or 3 years away. Apple will do what it's always done, and that is drop 40 to 50% or more. All right, I wanted to say from a technical perspective, we are still above, and this is why the market hasn't buckled. The big boy here, Apple, the 800-pound gorilla in the room, is still above its 40 weeks. It had a successful test recently, and that's where the algos fired. They came in, and you see Apple touch the 200-day just like it did here, they buy. That's what the computers are programmed to do. But now if that buying is met with continued selling and there's not follow through buyers, it's going to break it. So that's what I'm watching for. When Apple cracks that trend line, and pretty much, again, keep it simple. That's what I keep saying. Keep it very simple. If we take out the recent lows from last week, we've taken out the 200 days because that's where we bounced on Apple, and that's where the market hit some key support levels. Microsoft. Now, here's where I wanted to go, guys. Okay, Apple is one stock. It's important it is not the market. Here's Microsoft. 200-day moving averages. Below. Back tested. Below. We're still trading below both the 40-week exponential and simple moving average. And here, we'll turn off all the lines. You can see that's what happened. COVID, we briefly hit it. Got right back above it. There was actually not even a whipsaw because we intra-week moved below but held that 200 right there. Again, it just works as great support and defines bull and bear markets. Other than choppy periods, that's where you stay away from MAs. When you're in sideways trading ranges and you're on them because the market flattens out, you'll move. Trending markets, it works well. And that's when you break it in a trending market. And that's what you did back in 2007 when the stock market broke, and Microsoft, as good as a company as it was and still is, went down with the rest of them. I was trying to zoom in there. For some reason, I can't grab the little zoom feature, but that's right there where they broke down. You can zoom in on your own chart, and it stayed above every back test, just like the stock market, until bear market was over right there. Oh, that was 2000. I'm sorry, all the way back in 2000. Here, let me see if I can zoom in here. There's 2007 bear market top, broke it right there, back tested, perfect back test along the way. So once you took it out after the initial back test failed to do it, that's where the big drop came. And so it's like that little mall when you walk the map when you walk into a shopping mall, the "you are here" thing. I don't know. All I'm saying, it's very possible is when you look at that map, it may say "you are here," because that's what, when we zoom back into today, well, we broke it, we're back testing. And so we could see this, or maybe it's just going to be a whipsaw and we see recovery, or we could trade on it for another couple months. A lot can happen. But when you start to move away from it, especially once you undercut that low, then it's been a clear rejection. It's obvious to all, or at least most. And it only has something in the markets only have to be obvious to most, not all. And let's look at Alphabet. Same thing. Right now, below the 200 simple and right on the 200 exponential, trying to hold it. Amazon is clearly below its 200-day moving averages. Tesla is right on there. It took it out last week, but we're currently testing both the 200 simple and exponential. Again, for 40 week, we're on a weekly chart. It just looks a little easier, cleaner to see with these weekly candles and the dailies. There's Alphabet, the other class, right on there, Class C, I believe that is. And there's the 200 or the 40 week simple. And then you go down the line, NVIDIA. Look at this. just clinging to these 40-week moving averages. So again, a solid break under those recent lows will take out those two previous lows and clearly have a rejection off the 200 days. Let's look at the last time that happened on NVIDIA. You can see they successfully defended them there. That's where buyers came in and they were rewarded for buying pullbacks to the 200. But back when that was in the fourth quarter of 2018 when they were taken out, from the point that lost the 200s, NVIDIA fell 50%. You would have lost half your money in NVIDIA by not heeding the warnings, or at least wait till that's solid. Let's just say you waited to that solid weekly close because I grabbed a little high, you still would have lost 45, 46%. And then you knew you were in a bear trend. You came back, you tried to get above them, boom, rejected. And that rejection, if you shorted it, it was a 30% drop, but finally it regained them. So that's where we're at, guys. And I could go down the line. There's 100 stocks or companies in the Nasdaq 100, 500 in the S&P 500. I could do this all day long, but we really only have to look at the leaders. And when we do that, here's one that finally, after giving it up, boom, the bottom fell out. That's Facebook. So all right. Now, last but not least, we could look at sectors. I'm going to tell you the same thing. We can see most of the sectors are below key levels, and it's not just the moving averages, guys. It's price support too. We're really pinched. A lot of things that I'm seeing now are pinched, between price support and resistance. Resistance either being, in some cases, trend line or price resistance, or moving averages. So that's where we're at. We're in a little consolidation period, if you will. And if the bulls win, we do that. If the bears win, we're going to do that. And I could go down each and every one, but I told you I wanted to talk just real quickly about the pension funds. Okay, so in the video that I published earlier today before this one, I posted this in the comments section. And then loop back to yesterday's video, I was talking about ripple effects. I try to look at the market with a completely holistic approach. I look at little niche things people aren't thinking about, again, whether it's treasury bonds, credit spreads. I look at the municipal bond markets on a near day, all the bond markets, junk bond markets, investment grade corporates, everything. I look for yellow flags, any kind of abnormalities, things that don't mesh with what should be happening. And one of the things I've talked about, and I don't think this market is discounting enough, this whole Russia-Ukraine thing I think is a real deal. There's been a lot of things that have really come, like they were going to take the markets down. They didn't, for whatever reason, just dissipated. Or the Fed came in and saved the day. And we all have our opinions on what's happening over there and how much, if it's going to get better or worse. But most will agree Putin's just, he is not completely rational, and he seems to want the old Soviet Union back. So I've dubbed this, Cold War II is my term for what's going on. It seems like, the back in where we were 30 40 years ago. But we'll see. Now, what is certain is there's already been a lot of damage done, and I don't think Putin's going to pull a 180 and cow down. Russia is just absolutely collapsed. These restrictions are working. Look at RSX. Remember I covered it yesterday, and we were down towards testing the lows back from when this thing first came out in 2009. We've smashed through them now. So this is again an ETF that is indicative of the Russian markets, the VanEck Vectors Russia ETF. It's dropped 76% since the highs, and just in the last 3 days, this thing has dropped that's about 70%. Okay, this is going to have implications. Obviously, it's having implications on Russia. That's a given from their stock market. But I think it has the potential to have huge ripple waves throughout the global financial system, including, this is what I was talking about, for years and years have been tracking. You'd need to do your own due diligence to this, but U.S. pension funds, it's not just any one of them. Just about the majority of them are grossly underfunded and have been for a long time, meaning they've got money put away for promises to pay retirees, state and municipal workers, certain benefits. But the problem is, and over the last several decades, people have been living longer and retiring earlier. That's been the trend since the 50s. Back in 1950, all the big companies, GM, IBM, they all had pension plans. And thing is, you retire at whatever the number was back then. Let's say 60. People tend to retire earlier, and you're dead by 65. Rough. I'm not pulling the exact stats, but I have seen these stats. I used to do this for a living. People, worked up to a later retirement age, and then with life expectancy, smoking cigarettes and doing what they were doing, and you didn't live as long. Now with modern medicine, you're living longer, and you're much less people on the whole don't exercise as much, not as healthy, but yet we're being kept alive by medicines. And so therefore what that's done to the pension industry, and it's been happening for years, is it's really really hurt them, because you have to pay out they have to pay out a lot longer. Those pensions go for life, and in some cases people are retiring younger. But so here's what I was talking about. So CalPERS and CalSTRS. This is the CalPERS is the California Public Employees Retirement Plan, something like that, and CalSTRS is the California Teachers Retirement Pension Funds. Those are the two largest public pension funds in the entire country, and they have been. And together they have a combined $1.5 billion in Russian investments. So anyways, here's what's going on. Newsom yesterday, or whenever this was published, the last couple of days, called on the heads of states for those two largest pension funds and of the University of California retirement system as well, to divest any Russian investments as the state joined other nations, because right now it's toxic. If you're holding those, you're supporting Russia, whether it's indirect or not. So now they got to dump them. They got to dump on fire sale prices. Read the article. There's no out. He wants to know plans where they can protect the assets and blah blah blah, mitigate losses. I talked about that recently. You can't now. When the Russian stock market is plunged 75%, guess what? You missed the boat to buy put protection or to sell out. All you can do is fire sell those assets. There's no buyer. There's not anyone said, I'll give you what they were worth 4 weeks ago or 2 months ago. And you want to buy, puts, it's too late. The puts are already, they've already lost value. So it's a hindsight thing. There's no protection. You can sell them, you can dump them right now. That's about all you can do at fire sale prices, and take a loss. Now look, it's not going to wipe them out, guys. They are, the numbers. What is it? 400. They're 468. I think they're under 500 billion total assets. So you're talking less than 1%. But it matters. That 1%, every little bit matters. And again, it's ripple effect. There's others, other funds, mutual funds, and many other pension plans that might own quite a bit more. And so again, this is the fallout from that. I don't think we've seen the full fallout yet. That's the problem. Financial markets are so complex, but so many moving parts, but they're all little cogs in the machine, and sometimes just one little gear breaks and then boom, it has a ripple effect. So I hate to preach doom and gloom. I've been sitting here telling you technically why it looks like we can go down, but and I often talk about how the fundamental catalyst for a big correction, a bear market, that's what it takes. That's what it took when COVID hit. That's what it took in 2007. I and others knew there was a bubble forming back in 2005, 2006, but the charts didn't say it was time. It started to say that in late '07, and then it started snowballing once all that stuff came out. All the credit default swaps and they were wrapping up bad mortgages with the liar loans and all that, and then they realized that both the banks and investors who bought the CDOs and all that were the bag holders here. They were holding worthless paper, basically AAA rated bonds that were full of junk that should have never been AAA rated. So anyways, when it finally all came out, then it started to unravel. So my point is the technicals were for a while indicating a bear market coming, and then boom, the fundamental catalyst sort of melded with the the charts, and that all played out. All right, that's it. long video now, but I will work tomorrow and going forward to get out those little tidbits, just levels to watch. And as always, I'll continue. If I can get the charts out, a few screenshots, I know that's even easier for most of you. There you have the chart, what might happen. So I'll still keep that up as well. And then on a final note, if and when it becomes time to focus on individual stocks, again, I'm been hyper focused on the markets, gold, bonds, things, the major asset classes, because in a volatile marketplace, if I see any stocks that stand out, I'll get them out to you. But my preference, personally, is to trade the futures. You're diversified. I don't have to worry about any one company. Like what happened to Facebook recently after earnings. You have just the risk of being caught against a huge gap against your position goes up exponentially in times of high volatility like this. So as such, there's already a big risk just trading QQQ or NQ futures. Why magnify that risk? You can make plenty of money pushing the Qs or those 3-time leveraged ETFs or futures, of course, which are inherently leveraged already. I don't, that's more risk than your broker will give you more rope than you need to hang yourself with as far as leverage goes if you have a margin account. I guess that's what I'm trying to say. So, all right, let me wrap it up here and get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great evening.